by printing billions of dollars in QE as the world came out of the recession in the spring of 2020. The Fed created not quite a bubble, but a massive move far above this is the 200-week moving average, and that created the conditions for this huge bear market when regression finally pulled the market back down to test this 200-week moving average. And of course they didn't learn their lesson, and now they're doing it again. This is the weekly chart. Let me go to the daily chart. So right in here, right in March, when the banking system started to collapse, the Fed started pumping billions of dollars of QE back into the market again, and they've created this huge move, mostly in tech, but in the general stock market as well. At this point right here, the NASDAQ was stretched 25% above this 200-day moving average, which is even more extreme than at the top back here in 21. So they're creating the conditions again for some kind of a crash when this topples over and regression pulls this back down to the mean again. So for many investors, they become more and more convinced that there's no risk when the longer this stays elevated, or the higher price rises. So I'm not sure if this is a consolidation that's going to break higher, or if this is a topping process that's going to lead to a severe correction. It is getting very late in this intermediate cycle. So I would take any breakout to new highs with a big grain of salt, as that's usually how these intermediate tops occur. When things become dangerous, big money will often try to manufacture some kind of a breakout that causes retail money and hedge funds to buy the breakout, and then they, of course, dump their shares onto the dumb money that's buying the breakout and get out of the way of the move back down. But this is the Fed has created a very dangerous condition here, in that they have stretched almost all of the stock indexes, again, insanely far above these moving averages, creating the conditions for a very severe regression event, probably in the not too distant future. So the temptation is going to be to become more and more bullish the longer this lasts, but the longer this lasts, the more and more dangerous it becomes, and the more likely that this is going to produce just another some kind of a mini crash event when this intermediate cycle tops and topples over into the next intermediate cycle decline, not unlike what happened when this parabolic structure toppled over and produced this severe move down. Now, I don't think it's going to be a bear market that lasts as long as this did, but we're running out of weeks in this intermediate cycle, so we're setting up the conditions for some kind of a semi-crash event when this intermediate cycle finally runs out of steam and collapses. So be aware. The longer this continues and the further price stretches above this 200-week or 200-day moving average, the more dangerous this market becomes.